Decentralization is a fundamental concept in the realm of cryptocurrencies, particularly in Bitcoin and other decentralized digital currencies. It refers to the distribution of power and control away from a central authority, like a government or financial institution, to a network of participants. This stands in stark contrast to traditional fiat currencies, which are typically subject to centralized control and power. At its core, decentralization in cryptocurrencies means that no single entity has full control over the entire network. Instead, control is distributed across a vast array of participants, often referred to as nodes. Each node maintains a copy of the entire blockchain, the digital ledger that records all transactions. This ensures that no single point of failure exists within the system, enhancing security and reliability. Bitcoin, the first and most well-known cryptocurrency, exemplifies the principles of decentralization. Created by an anonymous entity known as Satoshi Nakamoto, Bitcoin operates on a peer-to-peer network where transactions are verified by network participants rather than a central authority. This verification process, known as mining, involves solving complex mathematical problems to validate transactions and add them to the blockchain. One of the key features of Bitcoin's decentralization is its consensus mechanism, known as proof of work, or POW. POW requires miners to compete to solve cryptographic puzzles, ensuring that the network reaches consensus on the state of the blockchain. This mechanism prevents any single entity from gaining control of the network, as it would require a prohibitive amount of computational power to outpace the rest of the network. Beyond Bitcoin, many other cryptocurrencies also embrace decentralization. Ethereum, for example, uses a decentralized network to support smart contracts and decentralized applications, or dApps. Ethereum is transitioning from proof of work to proof of stake, a consensus mechanism that further enhances decentralization by allowing validators to participate based on the number of coins they hold and are willing to stake as collateral. Decentralized finance, or DeFi platforms, which offer financial services like lending, borrowing and trading without intermediaries, are another example of how cryptocurrencies leverage decentralization. These platforms operate on blockchain networks, removing the need for traditional banks and financial institutions. In contrast to decentralized cryptocurrencies, fiat currencies are controlled by centralized authorities such as governments and central banks. These institutions have the power to regulate monetary policy, issue currency, and influence economic conditions. Central banks like the Federal Reserve in the United States or the European Central Bank play a crucial role in managing fiat currencies. They have the authority to implement monetary policy tools such as setting interest rates, controlling inflation, and adjusting the money supply. These actions can have significant impacts on the economy, influencing everything from inflation rates to employment levels. Governments also exercise control over fiat currencies through regulation and taxation. They can impose rules on financial transactions, require reporting of income and expenditures, and levy taxes on earnings and capital gains. This centralized control allows governments to enforce laws and regulations, maintain economic stability, and collect revenue. While centralized control offers certain advantages, such as the ability to respond to economic crises, it also introduces vulnerabilities. Centralized systems are susceptible to corruption, mismanagement, and political influence. Additionally, reliance on a single entity increases the risk of systemic failures, such as hyperinflation or financial collapse, as seen in countries like Zimbabwe and Venezuela. Decentralization in cryptocurrencies shifts control and power away from centralized authorities to a distributed network of participants. This democratizes the financial system, allowing individuals to transact and store value without relying on intermediaries. In contrast, Fiat currencies centralize power within governments and financial institutions, which can exert significant influence over economic conditions and individual financial decisions. Decentralized networks are inherently more secure and resilient than centralized systems. The distributed nature of blockchain technology ensures that no single point of failure exists, making it difficult for hackers or malicious actors to compromise the network. In contrast, centralized systems are more vulnerable to cyber attacks, fraud and mismanagement due to their reliance on a central authority. Decentralized cryptocurrencies offer greater transparency and trust through their open and public ledger systems. Every transaction is recorded on the blockchain and can be verified by anyone, fostering trust among participants. Centralized systems, on the other hand, often lack transparency, as decisions and actions taken by central authorities may not be fully disclosed to the public. Decentralization enhances accessibility and inclusion by removing barriers to entry for financial services. Cryptocurrencies enable individuals without access to traditional banking systems to participate in the global economy. In contrast, centralized financial systems may exclude certain individuals or groups due to geographic, economic, or political factors. Decentralization is a defining characteristic of cryptocurrencies like Bitcoin, offering a stark contrast to the centralized control inherent in fiat currencies. By distributing power and control across a network of participants, decentralized cryptocurrencies provide enhanced security, transparency, and accessibility. While centralized systems offer certain advantages, such as regulatory oversight and economic management, they also introduce vulnerabilities and limitations. As the world continues to embrace digital currencies, the principles of decentralization are likely to play an increasingly important role in shaping the future of finance.